Welcome to the Deep Dive, where we cut through the noise and really try to unlock the most important nuggets of knowledge from the sources you care about. Today, we're taking a closer look at Flexsteel Industries, ticker FLXS. We're digging into their Q4 fiscal year 2025 earnings call. And this one's pretty fascinating because, the home furnishings market, it's been, well, let's just say choppy.
Yeah, choppier than a stormy sea is how some have put it.
Right. But Flexsteel seems to be, defying gravity. They posted some really impressive numbers that definitely stand out.
Exactly. So our mission today is to figure out how they're doing it. How are they not just surviving, but actually thriving in this environment? We'll unpack what management talked about, their strategies, how they're tackling these, big industry headwinds, and crucially, what it all means for their outlook and, well, for you, if you're looking for some real insight into market performance beyond just the headlines.
Okay, let's dive right in. Those numbers really did grab attention. Q4 fiscal 2025, adjusted earnings per share, EPS, came in at $1.40.
$1.40. And the consensus estimate was, Lenny, 4 cents?
Yeah, selling 4 cents. I mean, that's a massive beat. Over 66% better than expected. That gets heads turning.
For sure. And then you look at revenue. They pulled in $114.6 million.
Which also beat expectations. The street was looking for $111.9 million, I think.
That's right. So a beat there, too. And it marks a pretty solid 3.4% year-over-year increase, in this market. Consistent top-line growth like that. Many competitors would probably love to have that right now.
Absolutely. But it's not just the top line, right? The profitability story is, well, it's pretty compelling too. Gross margin hit 23.9%. That's a 260 basis point improvement compared to last year.
Yeah, 260 basis points. And for folks listening, that just means for every $100 in sales, they kept an extra $2.60 in gross profit versus Q4 last year.
And a big driver there was peso translation, about a 300 basis point tailwind from that.
Correct. That peso translation context is pretty important. Basically, the Mexican peso got stronger against the dollar. So their costs down in Mexico looked cheaper when they brought the numbers back into U.S. dollars. It was a nice boost.
Okay.
Though, to be fair, they did mention about a 40 basis point headwind from tariffs. So it wasn't all easy sailing.
Right. Tariffs are definitely part of the story we need to get into.
Yeah, but even with that tariff drag, the currency effect definitely helped the margin number look good.
And the good news didn't stop there. Adjusted operating margin, 9.0%.
9%. And that's up, 340 basis points year over year?
Which is huge. I mean, operating margin, that's profit from the core business before interest and taxes, a jump of over 3% there. That signals real gains in efficiency and cost control.
Absolutely. And then look at the balance sheet. They finished the quarter with $40 million in cash.
Solid cash position.
Very solid. And importantly, 0 borrowings on their revolver. That's their short-term credit line, so no debt there.
That's a big green flag, especially now.
It really is. Plus, they generated around $19.1 million in free cash flow just in the quarter. That's money left over after running the business and investing. Really robust cash generation.
And these numbers, they aren't just a flash in the pan. This is, their 7th straight quarter of year-over-year sales growth?
7th consecutive, yeah. And 9th straight quarter of year-over-year adjusted operating margin improvement.
9th. In this kind of market for home furnishings, that kind of consistency is, it's almost unheard of.
It really tells you something about their execution. They seem to have really dialed things in.
And the market reacted, didn't it?
Oh, yeah. Big time. The stock surged in pre-market trading right after the earnings came out. And when we say reacted, the trading volume shot up fast, like 5 times its normal 3-month average.
Wow.
That's not just a casual glance from investors. That suggests people who are normally pretty cautious in this sector saw something genuinely different here, like a real reevaluation.
Okay, so let's unpack that. The numbers paint a great picture, but why? What's driving this? Management's message was pretty clear, right? Our strategies are working. The CEO, Derek Schmidt, kept hitting that point.
He did. He emphasized diversified growth, both in their core areas and in new markets, too.
Yeah.
And if you look at the full fiscal year, FY25, the numbers back that up. 7% sales growth for the whole year.
Okay.
Adjusted operating margins up 270 basis points to 7.1% for the year, and adjusted operating profit up 71% to $31.2 million. Huge jump.
71%.
And they generated $45 million in free cash flow over the full year, which, allowed them to raise their dividend twice in the last 12 months.
Raising the dividend twice. That sends a strong signal about confidence in future cash flow.
Definitely a positive sign for shareholders.
So what are these winning strategies then? In their core markets, they talked about deepening relationships with key accounts, customer segmentation, better experience.
Right, improving the customer experience, being more strategic with their biggest retail partners.
And on the product side, they mention using consumer insights for bigger, bolder innovation and faster launches. But what does that actually mean? How do you get bolder innovation that works when things are so choppy?
Yeah, that's a fair question. It's not just about running surveys, apparently. They talked about using deeper research, like watching how people actually use furniture, maybe even some predictive analytics, trying to anticipate shifts, like changes in living spaces, smaller homes maybe, or multifunctional furniture needs, not just chasing the latest color trend.
Okay, so trying to get ahead of the curve.
Exactly. And then beyond the core stuff, they're pushing into new areas, health and wellness with these ZCLINER products.
ZCLINER, what is that exactly?
Think specialized recliners, maybe for therapeutic use or designed with specific health needs in mind. It's kind of a niche, but potentially high margin area.
Smart diversification.
Interesting. And they also mentioned case goods, right? Case goods. That's your non-upholstered stuff. So tables, dressers, cabinets, that sort of thing. They're planning new product expansions there in fiscal 26. Again, broadening the portfolio, capturing more spend when someone furnishes a room.
Got it. And distribution too, right? They're not just relying on traditional furniture stores.
No, definitely not. They mentioned pushing harder into Wayfair, into Costco, exploring partnerships with Macy's and other big national accounts.
Yeah.
The goal seems to be, like they said, everywhere consumers want to buy furniture. That multi-channel strategy is probably key to their market share gains.
Okay, now, tariffs. This feels like the elephant in the room, or maybe the container ship from Vietnam.
Yeah, pretty much. Management was very upfront about it. That new 20% U.S. tariff on Vietnamese imports, they called it a major risk.
Major risk for both demand and margins in the new fiscal year. That's significant.
Absolutely. This isn't a minor issue they can just brush off.
Yeah.
So they have a plan.
The tariff playbook.
Exactly. Their term. It's got multiple parts. One is actively shifting supply chains away from Vietnam to other countries.
Okay, diversifying the sourcing. Makes sense.
2, pursuing really aggressive cost savings across their entire supply chain, not just manufacturing. And 3, implementing what they called limited pricing actions.
Limited pricing actions, meaning price increases, basically.
Essentially, yes. Specifically, they rolled out tariff surcharges. These range from 4% up to 8.5%, and they kicked in August 1st.
Okay, 4 to 8.5%. But they also did something else, right, to offset it?
They did. Crucially, at the same time, they reduced some existing surcharges, specifically the ones related to ocean freight, which had come down anyway. The goal was to try and keep the final retail price relatively stable for the consumer, or at least minimize the sticker shock.
So passing some tariff costs through, but trying to cushion the blow.
Right. And they stated they believe they're at the low end of the competitive set with these new surcharges. They seem pretty confident these actions taken together will largely offset the hit to their margins.
That's a bold claim, offsetting a 20% tariff impact. You mentioned it came up in the Q&A. How confident are they, really, given how choppy demand already is?
It's definitely a key question. Their confidence seems high, based on the call. They emphasize the multifaceted approach. It's not just the price surcharge. It's the supply shifts, the cost cutting, plus the pricing. But yeah, the ultimate test is always consumer reaction and how competitors respond. It requires really nimble execution, which, to be fair, they've shown they can do. But it's certainly the biggest watch item right now.
Okay, so what are they guiding for next quarter then? Q1 of fiscal 26?
For Q1, they're guiding sales between $105 million and $110 million.
Which represents?
That's about 1% to 6% year-over-year growth. So
Yeah.
still growing, even with these headwinds.
And margins?
GAAP operating margin expected between 5.5% and 7.0%. And gross margins in the range of 21.5% to 22.5%. And importantly, that guidance assumes the Vietnam tariff stays in place.
Right, assumes the headwind continues. But what about cash flow? You said they generated a lot in Q4, but the Q1 projection is different.
Yeah, Q1 free cash flow is projected to be negative, somewhere between negative $5 million and zero.
Why a swing?
It's mostly seasonal timing. Q1 is typically when they have big cash outflows for things like paying out annual bonuses, incentive comp, paying annual insurance premiums, Stuff like that hits in Q1.
Ah, okay. So more of a timing thing, not a fundamental problem with cash generation.
Exactly. It's a known pattern for them.
Yeah.
And they're still planning to invest, projecting CapEx between 1.0 and $1.5 million for the quarter.
Got it. And during the Q&A, analysts were digging into this tariff stuff, right? Anthony Lazinski from Sidoti & Company asked about demand elasticity. Basically, how much will sales drop if prices go up?
Yeah, he did. Management's response was that they've worked really closely with their retail partners on this. They feel they aren't at a competitive disadvantage with their surcharge levels. They also confirmed those cost-saving initiatives we talked about. They're already baked into that Q1 outlook. So, again, they reiterated their confidence in mostly offsetting the tariff margin impact.
Okay. And Bill Desselin from Tate & Capital Management asked about the broader market. What's Flexsteel seeing out there overall?
They stuck to that choppy and sporadic description, especially for the summer months. They pointed to the tariff uncertainty itself, plus potential inflation worries, and of course, still high interest rates impacting big-ticket purchases like furniture.
So acknowledging the macro challenges.
Definitely. But they also said they remain bullish long-term. They see underlying strength in housing demand eventually and expect an economic recovery down the road. So cautious, short-term, optimistic long-term.
And there was one more clarification on the Q4 numbers, something about the peso again.
Right. The CFO just clarified the size of that currency benefit is about $1.9 million favorable foreign currency translation from the strong peso in Q4. He noted that without that specific tailwind, their adjusted operating margin would have been closer to 7.3% rather than the 9.0% they reported.
Oh, okay, so still very strong, but puts that 9.0% number in better context. The peso was a significant helper.
Exactly. It helps understand the components of that margin beat. But, stepping back and looking at the big picture, Flexsteel's performance really does stand out. You hear industry surveys talking about historically low final mile furniture demand. That's actual customer purchases.
Right, the end demand is weak overall.
Yet Flexsteel keeps posting quarter after quarter of sales and margin improvement. It really suggests their specific strategies and execution are working exceptionally well against those broader headwinds.
So wrapping this part up, what does it all mean for someone tracking this company or the sector? That strong balance sheet, the cash, no debt, that's got to be a huge advantage right now.
Oh, absolutely. It gives them flexibility, staying power, options that highly leveraged competitors just don't have. And their capital allocation plan seems consistent and shareholder-friendly. About 70% of operating cash flow goes back into the business for growth.
Reinvesting for the future.
And the other 30% gets returned to shareholders through dividends, like those 2 increases, and also potentially opportunistic share buybacks.
Which they can afford to do, given the cash generation.
Precisely. So key things to watch going forward. Definitely that Q1 performance against their guidance. That'll be the first real test of this tariff playbook in action.
Right. How well does that tariff pass-through actually work?
Exactly.
Okay.
And how successful are they in shifting suppliers out of Vietnam? Does that go smoothly?
And are those newer categories, the ZCLINER and case goods, continuing to gain traction?
Yep. All crucial indicators. And then, of course, the macro stuff always looms large.
Mortgage rates, housing activity, any more twists in tariff policy. All of that could definitely impact demand and margins. Their execution needs to stay sharp.
No doubt about it. Agility is key.
Okay. Now for the part of the show where we put on our imaginary hedge fund analyst hats. Time for an outrageous but plausible trade idea based on this call. And let's be super clear, this is not financial advice. Purely for entertainment, maybe get you thinking a bit differently.
All right. So, given everything we've discussed, Flexsteel's strong cash position, their consistent profits despite the crummy market, that aggressive tariff plan, here's an idea. A relative value outperformance play.
Okay. Relative value. Unpack that.
The idea is you go long Flexsteel stock, FLXS. You're betting on their specific strengths, the operational execution, the potential for more dividends or buybacks because of that cash flow, and zero debt.
Okay. Long FLXS. And the other side of the trade.
At the same time, you short the XLY. That's the Consumer Discretionary Select Sector SPDR fund. It's an ETF tracking the broad consumer discretionary sector.
So you're betting on Flexsteel to do better than or outperform its wider sector, going long the company, short the sector benchmark.
Exactly. You're isolating Flexsteel's company-specific strengths. The bet is that their unique tariff playbook, their growth initiatives, will let them keep winning market share and protect profitability. even while the broader home furnishings world and consumer spending in general kind of struggles with interest rates and softer demand.
Makes sense. The macro headwinds justify the short on the sector.
Right. And the potential for Flexsteel to maybe buy back its own stock cheap, which management hinted at as an option. That adds a little extra juice to the long FLXS case. It's basically a conviction play. You believe this specific company has what it takes to navigate the storm better than most of its peers.
Interesting. A long-short pair trade focused on relative performance definitely fits the outrageous but plausible brief. All right, that wraps up our deep dive into Flexsteel Industries' Q4 fiscal 2025 earnings. What a quarter indeed. Really shows strong execution, proactive moves against some pretty serious challenges.
Yeah, they really do stand out. Clearly focused on growth, profitability, smart capital management, all while juggling this, really complex external environment.
Well, remember, this is the deep dive, trying to be your shortcut to being well-informed. Everything we talked about today was based on the company's own public statements during their earnings call.
And just one more reminder, that trade idea we kicked around, it's purely for informational, maybe educational purposes, absolutely not financial advice. Please do your own research.
Absolutely. Thank you so much for joining us today. We hope this look at Flexsteel provided some valuable insights into how a company can potentially outperform in tough times. We always love to hear your thoughts, so let us know what resonated. We'll be back soon with another deep dive into the source material that matters to you.